It's being led by Michael D'Onofrio, Managing Director of Engineered Tax Services. And he's going to be talking about the human behavior behind the winners and losers of commercial real estate. He'll be moderating the panel. I want to thank all the panelists for their time and preparation. And I'm going to turn this over to Michael. Michael?
Thanks, Mike. Can you hear me okay?
Yes.
Excellent. Well, thank you all. And thank you to the FLIA team, Michael, Jeremy, everyone else bringing this together. And we have a great group of panelists today. This is a extra interesting topic, I believe, and we have a very diverse group of different industry segments and asset types and focuses. Interesting 2020 year that we all had. Just a little background on myself and my team, so you know where my expertise and talking points comes from. I'm going to also be leading the team through the discussion here, and keep it really interactive, because I think there's a lot of different perspectives on different properties to be discussing. Again, my name is Mike D'Onofrio. I'm Managing Director with ETS, Engineered Tax Services. This is probably my fifth or sixth different event here doing with the FLIA team. And they're always great, very interactive. Our focus as a firm is typically all the specialty federal, state, local incentives, credits, rebates, et cetera. Not your typical CPA firm. CPA firms and family offices and investment groups are typically our clients as a specialist. But with everything that happened in 2020, those are the types of stimulus plan type new incentive programs and packages that we focus on, whether it's the CARES Act, or the Secures Act, or the future maybe infrastructure programs, or the prior Trump era Tax Cuts and Jobs Acts. Those are all the specialty incentives for all different types of real estate that we typically focus on. And the benefits are substantial. A lot of client interaction the last few days as we head towards the 2020 tax filing deadlines. Make sure that you and your teams are really maximizing what was put out there by the last and current administration, that 100% bonus depreciation, do those cost seg studies, the tax credits on renewables and lighting and HVAC and envelope and all that stuff. Those are the types of things that we focus on. And we can be very, very strategic together and comprehensive. Let's make sure you don't miss anything, because those 2020 tax filings, which are due, starting in March and April, and then on extension, if you miss some of that stuff, I don't think much of it's going to be extended with the new administration. So please maximize it, get it into the tax return. There's a retroactive aspect of maximizing those losses, 5 years back, per the CARES Act. But that's all the kind of stuff that we do. Our group today is excellent, with Joe and with JDM, and Elizabeth with Group RMC, Larry with CBRE, Elizabeth with Sunstone. I'm going to let them each, quickly go through an introduction of themselves, what their focus is, and then we'll circle back and go through some interesting talking points. So we'll start with Joe, JDM Capital Hospitality Group. Obviously, there's a hospitality focus there. Joseph, can you give us an overview of yourself and your team and what's going on?
Absolutely. Good morning, everyone. Thanks to you, Michael, for leading us on there. My appreciation for Michael Corselli and FLIA for everything that they've done and continue to do to support our industry, as well as us as a firm at JDM Capital. So thank you to everyone and our fellow attendees as well. JDM Capital has been around for the past 17 years. Our focus is explicitly on real estate, obviously, and with a core focus on hospitality and hospitality related assets, whether that is furnished apartments that tie into hospitality. Transitional hospitality is the term that we have been utilizing for our next strategy and world of what we see. Our firm has focused nationally and has an existing portfolio of assets in both the select service world of both franchise and non-franchised assets. And we've done everything from develop, co-develop, co-GP, pref equity, and mezzanine transactions in that field. So we see a unique opportunity for repositioning of a lot of assets, and that's a big focus for us coming up in the 21 year. And happy to be here and answer any questions we possibly can to give some guidance and economical background.
Very nice. And one thing I forgot to ask, where are you coming from today? Where are you at geographically?
Geographically, I'm down south where I'm looking at some property, and mainly we've been, our headquarters is in New York, but I've been doing a lot of traveling and hubbing myself out of our offices where our main hotel operations is out of Florida.
Okay, great. Yeah, our home office is in Palm Beach, Florida. So maybe we can hook up in person, old school style soon.
Sure.
But I also live
Absolutely.
in Charlotte, North Carolina. So if anyone's doing stuff in the Carolinas or in Charlotte, looking forward to working together.
We
Elizabeth.
used to have an office there at North
Charles?
Tryon Street.
Oh yeah, well come
Yeah,
on back.
525 North Tryon, Leo Dell building, just down the road a piece.
Oh yeah, a lot of new buildings coming. Elizabeth, good morning. How are you?
Good morning. I'm doing great. Happy to be here.
Nice to meet you. So please tell us about yourself and Group RMC and your perspective on office in general.
I'm actually with Sunstone Properties Trust. I'm the Chief Operating Officer here. Sunstone's an operator, developer, and fund manager of workforce multifamily investments. I think something that makes Sunstone a little bit different is that we really focus on physically changing the nature and repositioning assets to drive NOI. We self-perform all of our renovation and really have a bottom-up investing strategy. We invest through discretionary funds and joint venture partnerships, and we focus on value add, opportunistic, and development strategies in the Sun Belt states.
Excellent. Thank you very much. Nice to meet you. And where are you at today?
I'm in Westlake Village, California. There's a lot of sun on me. Bright blue skies today.
Excellent. Excellent. Thank you. Larry, good morning. Larry with CBRE with an industrial perspective. How are you doing?
I'm doing great. Thank you so much for having me. I really appreciate it. So I lead a team of 9 in South Florida. We focus on leasing and selling industrial assets throughout the market. Last year, we completed 185 transactions, which is a record for us. We have an exclusive listing portfolio of 13.5 million square feet for sale or for lease. And we represent everyone from Prologis, First Industrial, Reef, all the way down to mom and pops who just have a single building. And we do sell and lease buildings down here. So thank you for having me.
Thank you for the overview. And yeah, it's definitely been a very hot sector, throughout 2020 and the pandemic in terms of distribution and industrial. So
Yep.
Looking forward to learning more about that. Elizabeth, good morning to you. Tell us a little bit about yourself and Sunstone Properties Trust. I know there's a multifamily focus there.
Hi, everyone. Actually, my name is Lisa. My full name is Elizabeth. So you have 2 Elizabeths on the panel. I'm actually with Group RMC. So I think those intros might have just been swapped, but you can just call me Lisa just to make it easier. But I'm a vice president on the family office and advisor relations team at Group RMC. So we focus on office. We're a long-term real estate investment group, and we're focused on low prices and great value. So it really started off as one family, back decades ago. It's grown to a collection of families from around the world that co-invest alongside of one another to buy large real estate partnerships. And in the past decade, the segment we've been able to find these types of opportunities in has been office properties in non-gateway markets. So this includes big office portfolios and office towers. We specialize in secondary and tertiary markets. And so within those markets, we're buying both in suburban areas and also central business districts. So we're big landlords in places like Kansas City, Columbus, Ohio, Memphis, suburban Chicago, Indianapolis, just to name a few. We actually just bought our first deal in Florida right before the holidays in Jacksonville. We bought the Talus Tower in downtown Jacksonville. So we've accumulated over 18.5 million square feet. Our portfolio is valued at just over $2 billion. So since we're one of the largest private office landlords, we have a pretty interesting perspective. Our portfolio can really just sit on its own as a data point. So really excited to share those perspectives with everyone today. We're also finding a lot of opportunity on the acquisition front. So we're taking advantage of some of the price dislocation in the market that's taking place due to the pandemic. So thank you so much for having me, and excited to hear from the other panelists and discuss with everyone today.
Excellent. Thank you, Lisa. Yeah, and agree. I think you have an interesting perspective, especially for this topic on, human behavior. What's going to be happening with the, with the back to work strategies and office perspective. So yeah, definitely looking forward to learning some more. So we'll go back to Joe. Back to the top. Joe, give us some perspective on the history of hospitality. I know that's kind of a broad question, but what's the evolution? What's happening, and where are we going with what we learned in 2020?
Sure. Joseph, if you don't mind, just make it a little easier.
Okay.
So everybody remembered. So yeah, so from our side, I think that it's important when you look at the world and you see historically, you can go back and use New York as a template. And what I mean by that is you looked at the Plaza Hotel, and if you looked at things like the Waldorf that were magnificent and large, and you had 1,200, 2,000 room kind of monstrosities, and there was already an evolution shifting away from that. That's why the Plaza was going part condo, part hotel, and reducing its overall room count, because the demand for those keys have historically, over the last 50 years has been slowly reducing itself, especially over the last 30 in an accelerated way. And that's taste, flavor, experience in regard to what people are trying to be able to achieve. So what you had coming into this current market, you already had, let's say, that already shifting over the last few years to, let's say, that 800 even coming to that 500 in that convention hotel kind of concept. The larger hotels, the larger esque hotels went to where entertainment was, like the Vegas, Macau, etc. There was not CBD need for a 2,000 room convention center hotel in the middle of Manhattan or in the middle of any CBD. People didn't, and I think that if you accelerate that forward, where we in the last market went from a 500 to a 300, I think that it may even be smaller than that. So in our world, we see everything from 100 to 250, 300 is the top stone of what we see, and that may even be smaller in certain segments. With the world that's evolving, we see that the smaller assets are going to be the ones that are going to be higher in demand. People are not going to feel comfortable for a while walking around on the convention floor with 5,000 people around them, who has masks, who doesn't have masks, who was vaccinated, who wasn't vaccinated. There's a tremendous psychology that's been jolted into this asset class. Commercial office has changed, residential has changed. Definitely, there's been an input in regard to industrial and so forth in regard to how that works. But hospitality is in a state of complete evolution in regard to what that is. People wanting more personalized experience, and that's why our transitional hospitality segment and thinking. If you look at the plaza is like a foreshadowing of where the world would kind of continue towards. We see that hotel and residence concept is a way for us to be able to come in and redevelop existing transactions in an accelerated way to be able to generate cash flow and to be able to stabilize an asset. So the history in regard to key count and that experience is becoming more and more personalized. So it's beyond just, we're welcome and happy to see you. It's like, how safe am I going to be there when I'm there? How am I going to feel? How is the property properly cleaned? How are you communicating your cleanliness to the operator? The operators are communicating that to their guests. How is the property operating? Are you letting 50,000 people on an elevator? Or people, is there management of the crowd management and social distancing, and how is that working? Food, we're now putting into one of our hotels, we're making a touchless bistro and creating a concept of where you can be able to go in and, basically, press and go, not just plug and go, what you're going to be able to have. So those are the history and evolution of where people, are looking to try to be able to find that common ground and want to be in, a room with 300 people. I think that's going to be a big miss and change over the next evolution. So, bigger is not better in this circumstance, reflecting on history to where we are in the hospitality industry.
Yeah, I have a ton of questions about that evolution, and it's going to be interesting to see what happens. I mean, events like this, we used to do them all the time in person, and I think a lot of us want to get back to that in a certain capacity, maybe not 500 people at that event, but much more interesting, more focused target breakout sessions. I'm not sure, but I'll get back to you with some follow-up questions. Liz, from that multifamily perspective, how has your strategy changed in terms of the properties, are similar to the hospitality? Are the bigger properties, taller, still very interesting, or are you looking for, more low rise, garden styled? Has that made a difference at all on the multifamily side of things?
Yeah, I think all of our assets and locations have really performed well during this investment cycle. When our principal started Sunstone Properties Trust, they really were focusing on an asset that could perform well during every economic cycle, every phase of the economic cycle. So I think that it's been reassuring to know that our investment strategy has done well for this. We focus on, I mean, all of our assets are garden style apartments in suburban markets. So we don't have, that concern about, urban infill, high rise buildings, sharing of elevators and things like that. So I think the fundamentals are still very strong and support our investment strategy. In 2020 specifically, we just shifted our focus from pushing rent growth and pushing a pretty aggressive renovation schedule to stabilizing our assets. So we offered lease renewals at no increase. We slowed down our renovation schedule and we just tried to get occupancy as high as possible, just because we didn't know how collections were going to be in the year.
And mostly Sun Belt state focus, that Florida, Panhandle, into Texas as well.
Yeah, exactly.
Okay, thank you. Well, I'll go back to Lisa. Fill in the gaps from an office perspective. What you gave us a bit of an overview there. How has the portfolio been impacted? How has the strategy shifted? If at all, are those spaces and utilization of those spaces by tenants? What are you hearing out there?
Yeah, absolutely. I can first kind of talk about our portfolio and how it's performed, and then just some sort of side effects, good or bad, that we're seeing on the leasing side, because there are a couple of interesting stories that I can share. So first, just to start out, we collected 98% of our rents each month since the pandemic hit. So obviously, very happy with that performance, and that the majority of that 2% that has not been collected is not forgiven rent, it's deferred rent. And the vast majority of those tenants were more amenity type tenants anyways, whether they be delis or cafes. So, those are businesses that at one point weren't even allowed to be open. So, we worked out sort of payment plans with them. So 2020 was really the ultimate stress test for us. And we were very pleased on how we performed. But our asset class, but more specifically our category within office, has been very resilient. And it's important to emphasize that not all real estate revenue is created equal. So having high quality income, income derived from thousands of corporations, and we're essentially a creditor to them with very long-term leases. So it's a little bit different, than some of these other asset classes that are not anywhere near 98% collection. And we have over 2,000 tenants across 200 buildings. So that one of our key disciplines is to diversify and mitigate tenancy concentration risk. So when we actually set up portfolios to acquire, that's something we pay a lot of attention to. We don't want any one tenant to make up too big of a footprint in our buildings. We never want to be in a position where if just one tenant goes dark, we're at 0% rent collection and totally struggling. So we do put a lot of Exactly. We put a ton of thought into our underwriting and how we structure these deals. So there's things that were, helping us kind of get to this point. But for the second part of the question, that, what are some side effects, good or bad, that we've been seeing? So there's a few different things as it relates to leasing activity that I think would be interesting to share. The first being that we actually saved a lot of tenants that were possibly going to relocate or move out of spaces into more expensive spaces. Whether they be new or, 30 or 40% more expensive. A lot of those tenants have actually just decided to completely forego those plans and not really move at all during the pandemic. And we have high quality Class A space at great value since we buy at a very low basis. So that really helps at a time like this. We also sign a lot of as-is renewals, more than we ever have in the past. So an as-is renewal is when tenants sign on for additional years on their lease without the landlord having to put in any tenant improvements. So, at no cost to the landlord. So this has the best landlord economics. The reasons for so many of these is is likely because a lot of companies want to sort of kick the can down the road until there's more certainty on what they want to do with their space. We've also seen a few companies actually wanting to take huge losses for the year in 2020, and they've paid out the rest of their lease at a 100% of rent value. So just to use an example, this happened recently. We effectively got paid for a space that a tenant was supposed to occupy until 2025. They just paid out the balance of what was left on their lease. They wrote us a check for that amount. So that means if we're able to lease up the space, the tenant moves out, we'll effectively be earning double, in the same space. So it's a double-edged sword, because it does affect vacancies, but it's a pretty interesting dynamic, has great economics for us, and sort of proves just how crazy the world is right now. So leasing activity and the quality of the leases has been solid. We haven't had to bring down rents in any market that we're in. Everything's stayed market rent. And we've been signing new leases. And an interesting fact is our portfolio is actually more leased today than it was back in December 2019. So not by a huge amount, but there's not a trend in the opposite direction. So this leasing activity is not the case for every single, real estate asset class or sector out there, but in our specific niche, this is what's going on, and it's been a pretty positive story.
Definitely some tax strategies, as I mentioned, what tenants and owners were doing this year, and some people didn't understand why, but like I mentioned with the CARES Act and those increased losses that they could use, the loss carryback provisions. That's why you're seeing some of those strategic moves, either to pay things off or to take the loss or to write things off or to do tenant improvement and build out or demolition. It's just a lot of strategic things that were happening towards the end of 2020 there, and I think some of that's going to continue here in 2021. We're not sure with the Biden team how much of the tax strategies are going to be extended, but great comments there on that. And I'm interested, Larry, tell us about that industrial perspective. I have a feeling it might be a lot more positive than what some in the hospitality and others have experienced, just given the nature of the distribution and industrial perspective. But what's going on?
Sure. Thank you so much for having me. So, 2020 was definitely a mixed bag, and it wasn't without its challenges. I think the things that were most interesting looking back on 2020 was e-commerce and the rapid expansion. And I know it's talked about a lot and it gets a lot of press, but I'm here to tell you that it's real and it's here to stay and it's going to continue. These companies that were in the market last year are continuing to invest in their supply chains. They are expanding rapidly. The who's who of e-commerce, the Fortune 500 that need to build out their supply chains are investing heavily in it. And I think what we've seen to date is just a blip, and it's going to rapidly expand. Everyone's favorite e-commerce provider, you all get their boxes, in your house every day. They are expanding dramatically across the country, but just here in South Florida, they've leased millions of square feet, and they're going to take millions more. And they almost single-handedly moved the market and continue to move the market. All of their competitors are doing the same thing, not at the same scale, but they're investing heavily in their supply chains. And 2020's bright spot was definitely e-commerce related. The other thing about 2020 that was, in my opinion, a little bit disappointing in our space was that 40 to 80,000 foot tenant that down here in South Florida really used to move our market. They were pretty quiet and reserved. They did a lot of 1 and 2 year renewals, as is, no TI, kind of like Lisa was talking about on the office side, and kicked the can down the road. And in some cases, it was great that they kind of took a breath, because we renewed a bunch of tenants that we would have lost to much bigger spaces. But at the same time, the absorption wasn't there. So it definitely took a little bit of the wind out of the sails. But the e-commerce side more than made up for it. So, looking forward into, 2021, you're going to continue to see a rapid expansion in e-commerce. You're going to see the top e-commerce players open up hundreds of new locations across the United States and dozens in South Florida specifically. which is going to be a great opportunity for anyone who's in the market or looking to get in the market. The other thing I would say just really briefly is on paper, small bay industrial, like little 10,000 square feet and less bays, traditionally in a reset or a downturn, a recession, whatever you want to call it, perform very poorly. In this case, during the pandemic, it's been exceptional. We are at record rents. We are at record occupancy in small bay. Generally, those have much higher returns than the core stuff. So the returns have been very, very good for a lot of those owners. And yes, you had a bunch of people kind of pull midnight moves in the beginning of the pandemic. But as the second quarter, third, and fourth started to roll around, we are at record levels in small bay. So I think looking into 2021, that's something to watch out for small bay industrial.
Excellent. Thanks for that glimpse into where industrial is going. Joseph, I'm going to go back to you. Give us a glimpse of, you started to touch on it, on hospitality and the hotels of tomorrow. What is it going to take to be successful? What type of property, what type of new build and or existing property changes are we going to be seeing in the future?
Sure. I believe that you're going to see a reduction in expansion in major CBD markets. I think that you're going to see a reduction in existing supply in current markets because of the demand drop off, the changes in clientele and guests. Your business traveler is very well unknown. Everyone knows about the Vegas ICSC event, right? Are you really sending 50 brokers out there on the floor and looking at those costs and those expenses? It's an issue. What that defines what's next in business travel and when does that come back? I think it's going to be a long haul. So the convention center hotels are going to be decimated like interior retail. And I think that the CBD supply is going to be reduced. I think that it's going to be, you're going to have what I would call flatter, wider assets that are going to be designed. You're not going to have as an appealing, unless it's, maybe on the Florida waterfront, but I don't think that anybody's really going to say, I want a 35-story hotel with 4 elevators and getting in that elevator. I think you're going to have smaller, contemporary looking, more spread out, more open air,
indoor outdoor
locations. Very important, very important. And I think that those
and mingling areas,
walkability. Yeah, you're going to have a lot of these, a little bit of more developed suburban areas that will have a high degree of walkability. I think that's going to be a factor. There's a reason that Hertz went bankrupt, right? In regard to their need and their demand and their usage dropping off. That says a lot in regard to it. I think that the resources that are going to be required to be flexible in an unknown world are going to require hospitality with some level of residential components to some parts of it, where you have kitchens and you have the ability to vertically control your food supply. So I think that people are going to be traveling with their family and they're going to want to know, yes, what if the restaurant's closed? What if something happens? So what's going to take steps to, I think for sure what's decimated are the pod hotels, those little hostels, the 4 bunk bed in 1 room, 25 people in 3 rooms kind of thing is gone. I think that those, there was one small player in that area that filed for bankruptcy recently. I forgot who they were out of initially, but it escapes me at the moment. But I think that's where it's going. I think smaller is better, more spread out, flatter, and dynamic.
Yeah, and maybe larger room requests with more amenities.
Absolutely.
I noticed that with my family. We have traveled. We've been to different places in Florida and Dallas and a couple different locations, both for business and for some things that we just needed to do and wanted to do. And I noticed some requests of those rooms from my family and my wife that otherwise wouldn't have come up. So I think a lot of other people
absolutely
are that.
Totally
More of an efficiency or suite type room and the willingness to pay for that.
Right.
Yeah, interesting.
Our project in Florida is set up that way, where we have lock-offs in adjacent rooms, and we're seeing the demand for hire there, as well as a component in again, that hospitality residence side of larger needs.
Right.
So people are changing how and why they travel. They want this, yeah, they might be running to their secondary home, but the idea with the mobility and the changes in the office environment, working remotely, people are utilizing that to say, you know what, I can go and spend 3 months in California and 3 months in New York. So
Right.
I can go and rent somewhere and it's not an Airbnb. The safety standards. See, Airbnb is a great marketing company without the ability to truly operate. They have no operations. They're no different than an Expedia or a Hotel Tonight. They're just a marketing engine,
Yeah, it's a
and
broker.
they're partnering with. That's right.
Liz, I got a question for you as it relates to, I mean, just like we were talking about with the changes of hospitality spaces and requirements. I'm sure some of the same requirements, from a multifamily perspective, from the tenants are being sought after, but also with the administration change and the moratoriums, I think there was an extension on some of that. What are you seeing on the eviction moratorium? Has that impacted collections? What's happening now, and what are you projecting going forward? You're still on mute, Liz. Liz, can you hear me? You're on mute. There you go. Still on mute.
I was calling in from my phone because I heard I was muffled, but
Oh, that's
at
okay.
the beginning of the pandemic, we were really afraid that tenants just weren't going to pay because of the eviction moratorium and that they would be protected. But we've been pleasantly surprised that people care about their credit. They care about paying their bills. From April to December, we've collected 97% of rent. And in Q4, it was 98%. Our worst performing quarter was at the very beginning of the pandemic. The moratorium, it's a really small percentage of our tenants who just are sitting there and waiting to be evicted. So I'm not that concerned about it. I am very thankful though that alongside with the moratorium, there's been money set aside for rent relief, which I think will be very helpful. I think the tenants that aren't paying are really just taking advantage of the system, but the overall majority really do want to pay. And if their hours are cut back, we just, we work on payment plans. We're communicating with them constantly. And I think the staff has had to work extra hard on collections and making sure that we're performing on that front.
Excellent, thank you. Lisa, back to that office perspective and the work from home requirements and requests from some of the employees and tenants. How is that impacting the business?
Yeah, definitely a great question. We've obviously weathered the storm very well up to this point, but that's definitely, without a doubt, the most asked question. So there is some truth to some of the themes you hear, but it does require sort of a nuanced approach as you sort of analyze the themes. So just to kind of talk about a few of them and how we're viewing it, the first theme obviously being the whole work from home concept, which we've all been forced to do. Safety wise, it wasn't safe to be in the office over the past, few months, especially at the beginning. It was sort of an emergency type of situation. But not all work from home analysis is positive, and not everybody is receptive to be working remote 100% of the time without even having an option to go into an office. And there's a number of factors that really fuel that, whether it be, a sense of community or productivity or wanting company culture, or even mental health concerns. Workers are more productive in a collaborative environment, and there's always going to be things from home that diminish that type of productivity. We might be seeing people having sort of like a flexed week where they pick the days they'd like to go in. That's certainly something that personally I could see happening. However, the fact that these companies will exist and you'll never ever go face to face with a coworker, you'll never even have a professional environment to conduct a meeting in for a lot of different roles, that's just completely not feasible. So from the people who sign leases and CEOs and thought leaders, there's a ton of data out there that's not showing that people are thinking they're going to get rid of all of their office leases altogether. In fact, we actually saw a lot of companies like Facebook and Google and Amazon were some of the first companies to jump on that bandwagon in March, saying, oh, we're going to have our employees working remote indefinitely. And those same companies now are snatching up huge office leases in cities like Denver and Detroit and New York and Phoenix. So it's just interesting to see. Also, JP Morgan, Netflix, Microsoft, Amazon are all companies that have come out and published that there's major shortcomings to remote work, and they're looking forward to getting their employees back to the office when they can obviously safely do so. And companies spend a fortune on trying to invest in software and technology to make their employees more productive, but office is such a cheap way to do so. So it really makes you kind of scratch your head. And obviously with a vaccine now, a lot of companies are optimistic that they can do so in some capacity, get some employees back into the office sooner rather than later. Another thing to just comment on is the thought that there'll be large scale downsizing and reduction of space. But on the other side of the coin, there's a lot of people who actually believe that some companies will require more space due to social distancing concerns. And over the past decade, things have been as dense as they possibly can be in office space. That you want to make the number of square feet per employee as little as possible to save on costs. And you have no elbow room at your desk. You put as many people in a room as possible. That's not really going to be acceptable anymore. There's now a sort of a level of hygiene that is going to be expected in office spaces. So I think that's a trend that you're going to see. Also, decentralization of office space and sort of hub and spoke configurations are definitely a possibility, where maybe your headquarters is in Chicago, but you have spoke smaller locations in suburban Chicago and Milwaukee, just easier to get to places. Also, if you're looking for more space, the value-wise, you're going to get the best value in places like the Midwest and Southeast and secondary and in tertiary markets where you're paying a lot less for the same quality. And also, last point, just the huge shift we're seeing, suburbanization and a shift away from gateway cities that Joseph was talking about. And there's a lot of evidence and research that's out there. And, gateway cities where employees have a very high cost of living, like New York and San Francisco and Chicago, Boston. These are places where momentum was really built into these high prices, and the momentum's no longer there. I'll leave it just on one last story from our mortgage broker. Actually, he was telling us back in December when we were getting ready to close on our deal in Jacksonville. And he's a New York guy. He's worked, in mortgage financing for a very long time. He was telling us about this Class A office building right next to Grand Central, an ideal location. Had much wider interest rate spreads than what we were seeing for this very nice quality asset, Class A asset in Jacksonville. So, banks are even viewing these buildings as riskier. So, there's clearly the gateway markets are taking the brunt of it. They're more expensive, and these non-gateway markets where people have a lower cost of living, they can drive to work. It's perceived maybe as, a better place to live in some regards. So these are incredible markets for people. We've liked them even pre-pandemic. We just hope they don't get too crowded with competition and drive up the prices there. So, that could be an interesting shift we see as well. So, those are just some of our comments on it, but it's a very interesting time.
I agree with your points, all of them. I also the tax perspective, every day I see folks, my friends and families and clients, if they're in New York or New Jersey or Connecticut or wherever in the Northeast or happens to be in California, seems like everybody. And I saw an interesting perspective, the largest number of moves in the month of December. Like number one was Austin, and it showed the inflows that came from California and everywhere else that went to Austin. And then number 3 and number 6 was like Raleigh, North Carolina, and Charlotte, North Carolina from the Northeast. And then of course, Florida. So getting to Florida, Larry, are you seeing that geographical shift also? I mean, I'm seeing it in the tax business all the time. And we hear it on the news, we see it, with tax rates and of course, state tax rates compared to other places. Is that a consideration for investment right now? And where's the opportunity to put capital to work if they were going to do it?
Yeah, so we're definitely seeing a huge influx of capital and people, seemingly almost hour by hour. I'm getting calls from the who's who of real estate from around the country that have either relocated and already bought a house down here, mostly in West Palm Beach, or are looking to at least grow a new portfolio in addition to their existing portfolios in California, New York, New Jersey, et cetera, down here. So it's a really incredible time. It's very exciting for South Florida. We're open, we're on. You can do business, restaurants are open. And it's not without its challenges, of course, but at least if you want to, you could have somewhat of a normal, day or life or evening. So I think a lot of people are attracted to that, and obviously, the tax situation is ideal here. So from a capital allocation perspective, it's flooding. I think you're going to see dramatic appreciation on the industrial side just from that sheer fact alone, that there's just tons of capital coming here and it's going to push up prices. A lot of people are chasing yield, and it's getting a little bit challenging to find, but there are some really good opportunities. And if you're looking for specific investment areas to put some capital to work in industrial, if you go to the Airport West or Doral Market over by Miami International Airport, or Fort Lauderdale Hollywood International Airport in Southeast Broward County in Fort Lauderdale, those core assets are trading at record prices. But if you're looking for some value, there are some pockets that are up and coming that are, I think, fantastic and really overlooked by the big funds and institutions. And those areas are where you haven't seen the same dramatic appreciation in rents. They've gone up, but at a less steep of an incline. And I think those areas, specifically around my International Airport, where the rents haven't really skyrocketed, I think there's some amazing opportunities there where people still think that it's inexpensive because it's not functional. And I disagree. There are certainly not functional buildings in that area, but there are functional buildings within that submarket that I think should be picked off, renovated, repositioned, rented, and either held or sold.
Right. Yeah. And I know there's still some good opportunity zone related geographies and properties around that area as well. I mean, opportunity zone is still a specialty tax strategy that is available. It's a little bit complicated and a longer hold, but if you're going to be doing those improvements anyways, something to consider. And I know that your CBRE team has a lot of experience with that as well. I'm working with Compy Newman and others here in Charlotte on some really nice projects. But thanks for that. Going to go back to Joseph. How are you? So going forward, how are you going to be defining success? And who's a survivor? How do you define a survivor and success going forward?
Well, I think the phrases themselves, a survivor is a person who's to a certain extent viewed themselves already as a victim. And I think that, a person who's a little bit more from a real estate perspective anyway, is if you focus on winning and you focus on success, you generally lead yourself that way. But I think that what's going to define those people's ability are three things. One is low leverage. Is going to be a consistent needed play in regard to those who do succeed and continue to succeed, because you have to understand the complexities of hospitality that include it's a real estate asset that's high yielding, but it's high yielding because it contains an operating business inside of it. Those key kind of encapsulations are what spins out it's higher than retail value than residential, but those are market moments and highs and lows. But what allows you to survive through those or into a win is those that fall off and will be eaten up in the excess supply and low demand of the higher yielding, higher leveraged up assets that have, basically you see it in the ones that are foreclosing, whether it's been recapped enough times where they're throwing, the keys on the table because they've already taken their money out, or they just don't have the capital to be able to reinvest. So reinvest, refresh, and reposition. So if I give you those 3 R's are going to be the things that are going to make a winner.
Got it. Jumping over to Liz, on the multifamily side of things, how has the market responded to the debt and equity to the pandemic in 2020? Are you seeing rates starting to tick back up now, or what's happening out there?
Yeah, when the pandemic first hit, I think all transactions just stopped because no one knew what was going to happen. We're seeing an uptick again in transactions. We're seeing owners and sellers not willing to take a discount because I think that there's going to be a lot more capital flowing into multifamily because the fundamentals are just really strong. And it's a good alternative investment. Freddie and Fannie have played a significant role in continuing to provide financing during this pandemic. I think the banks pulled back a lot, and it's not because of their multifamily assets, but because they didn't know, how all of their other loans would perform on other asset classes, including consumer debt as well. But we are seeing transactions. We've actually seen cap rate compression, and we're getting calls constantly for off-market deals to try and acquire our assets. So I think that values are going to remain strong in the multifamily sector long term.
Got it. Is it changing your underwriting on deals going forward, given what you're experiencing behind the scenes with folks calling you?
No, I mean, as far as dispositions go, we're holding strong on all of our values. As far as acquisitions go, we're underwriting a little bit of a softer market over the next year or two, just to be conservative. But we're still, even with our value add properties that are under renovation right now, we've seen rent growth of 8 to 10% for the year. So we're still bullish on our investment strategies.
Got it. Thank you. And Lisa, what lies ahead with your strategy? I mean, you mentioned some of those, tertiary markets and other things. Is it doing the same thing but better, or different places geographically, or what's the focus going forward?
Yeah, absolutely great question. So we're still focused on the same areas. As I mentioned, we just entered Florida with our very first acquisition in Jacksonville,
I
and
don't see anything in the
really,
Carolinas. Why nothing in
I
Charlotte?
know,
And
a
we
little bit
a
too
lot of opportunity.
expensive for us. Other people are on to how good those markets are, and just driven prices up a little bit more. We like to go where there's less competition. And we're looking for a good deal. So a lot of value is made at the buy, and buying inexpensively provides us with such a low basis and a lot of breathing room, and with cash flow, so we can beat the competition in the markets that we're in, and charge less for rent, and get leases more easily. So we want to be the low cost provider, which is difficult to do. It's difficult to find those deals, but in a strange way, a lot of these anti-office narratives are actually a blessing, because it's kept some competition away, despite a lot of these non-gateway tailwinds and the resilient performance of office in the category that we're in. But generally speaking, we really source investment opportunities from four main groups. I can just kind of chat about a couple of them, and that kind of leads me into where we're finding opportunity. The first being private equity groups, which own great assets, but are forced to sell a lot of times at the end of life of their funds. So that's where we come in, surety of closing. Also, pension plans and institutions also have a need to liquidate, and we frequently buy from them as well. In the category of distressed owners, we've had a couple of post-pandemic acquisitions in the past 3 months in that category. So we purchased a 500,000 square foot Class A office tower in Columbus, and also the tallest tower in Jacksonville from the same seller, who needed to get these assets off their books last year. And both of those deals came from failed sales processes that predate COVID. So we actually were able to acquire both deals at 20% discounts to their pre-COVID pricing guidance, and 70 and 80% discounts to replacement costs, the cost to construct the building today. So, huge value there. And the reason being is that there's really no other competition that showed up at that time, and that particular seller was in a situation where they needed to get rid of the assets. So both deals have tremendous upside, and we acquired it at a historically low basis. We're very picky. I will say we're underwriting a record number of acquisitions right now, but just because it's cheap is not a reason to buy. Fundamentally, Columbus, we're one of the largest landlords there. There's a ton of growth. It's a very business-friendly place. Also, same with Florida for a lot of the reasons that the other panels were discussing. The last category of opportunity I think it would be interesting to bring up, and that we're currently circling around, is publicly traded or private REITs. So we recently launched a vehicle to provide rescue financing for a REIT that we've been sort of circling around, that has healthy underlying assets, but the REIT structure is under a ton of pressure, and it's on the brink of a liquidity solvency crisis. So REITs are a tax structure that has to distribute 90% of their ordinary taxable income as dividends, but that limits their working capital reserves. And generally speaking, new acquisitions are funded with debt, and it can be hard raising equity when there's less investor demand, or difficult market conditions, or, the public perceptions that office is, out of favor. So many REITs are valued based on dividend yields rather than the actual value of the assets. So there's a few different reasons why the REIT structure can be distressed, but yet still have healthy performing assets. So we're working to negotiate a PIPE financing and implement various value creation strategies to improve the REIT's positioning. The REIT actually owns assets that are very, very similar to ours. So, similar rent collections, all of that. So that's just a few things that we're working on at the moment, but
Yeah, thank you. And I see some questions from the audience. Just as a reminder, if you do have questions, you can type them in to the Q&A section. We can address it if we have time now, which we're running out of time, but we can also, each of the panelists will be forwarded all the questions so that they can respond to them individually. And there's also a question, can they get a copy of the presentations? Yes, Michael and team will be sending out a copy of all the presentations and contact information, so the attendees will get that. Larry, speaking of deals, Lisa was giving us some good overview on deal flows and what's going on behind the scenes. And we got to get through this quickly, and then we're going to kind of do a wrap up topic of it for each of you. What do you see on as far as rents and pricing and deals getting done?
Rents are broken up really into 3 different buckets for bulk distribution down here in South Florida, and it's Class A, B, and C office, Class A, B, and C assets, excuse me. Class A rents are ranging, from I would say $10 to $13 a square foot, just quoting on the gross rents, so it's easy for everyone. Class B is really, $9 to $11 a square foot, and Class C rents are generally $8 to about 10 in that range. When you get into the small bay categories, you're looking at a really wide spread, and you're looking at sub 10,000 square foot bays, anywhere from $10 to $18 a square foot. And that's where a lot of the real value is, in my opinion, and a lot of the yield is in the smaller bays. We actually just got $18 a square foot in a small bay project owned by one of our clients for the first time ever, and it's a record rent. And so those are performing really, really well. Okay,
excellent. And so on that, any other final points that you'd like to make of why folks should be contacting you? What type of business you typically like to focus on? What are your final comments for the audience?
Yeah, I'm just happy to help. If anyone needs anything, if you're looking at a deal, we're not involved. We're happy to help you with underwriting. We're happy to provide comps. We have the best information in the market by far. We work with every owner out there, so we know what's rolling, what's coming, what the inventory looks like, who the most aggressive capital is in the market. So if there's anything we can ever do to help, we're happy to. And if you're looking to sell or looking to buy, or you need leasing, we can absolutely assist with that. So I appreciate it.
Excellent, thank you. And Liz, your final thoughts and comments. What is the best way for folks to work together with you and your team? And any other final things you'd like to say?
Yeah, we invest through discretionary funds. We're launching a couple of funds this year, and then we also do joint venture partners. So if anybody interested in investing in multifamily with a really strong operator who's boots on the ground, hands-on, we're your operator.
Sign me up.
Yeah, and one question that came in from the audience, and I'll ask you to follow up on that, Liz, is I know you mentioned the Sun Belt focus, but are there specific geographic areas that are experiencing the greatest real estate growth that the investors will be able to take advantage of?
Yeah, we like Florida. We're looking at Phoenix. We have assets in Dallas as well. We have some assets in Houston. Institutional investors have redlined Houston, and so we're actually seeing a lot of family offices and smaller players come into the Houston market because they're being priced out of other markets. And it has been performing for us. It's been pretty stable. So yeah, and then we're also looking at Nevada, and we're doing some infill development in the LA area.
Okay, thank you. And Lisa, to wrap it up, how can we best
Hey,
all work together?
Michael, I apologize. We have gone over the time limit for the panel.
Oh, okay.
Um,
I thought we were at noon, but that's cool.
I appreciate everybody who took the time today to prepare for the panel, and appreciate you sharing your insights. You guys covered a lot of important topics that investors today want to hear about, operators want to think about. It was a very interesting panel, and I want to thank all the panelists for their participation. So